Purpose is that same company that brought us those high-yield crypto ETFs, and they've done it again with their new high-yield tech ETFs. Holy banana bread, let's do this! Purpose has just released their new high-yield line of ETFs. These ETFs are quite similar to their crypto high-yield ETFs, like ETHY and BTCY. These new ETFs also use covered calls and a moderate amount of leverage to enhance the return they can offer you. Purpose's high-yield line includes some of the giants in American tech, as well as another giant all on its own. I did mention a risk in the title, and that refers to a little thing called return of capital. Many split core stocks use return of capital to help meet their higher dividends. Does Purpose High Yield do this as well? We will answer that and so much more as we dive into these new ETFs. Before we load up on a heaping helping of extra dividends, tell me in the comments if you hold any Purpose ETFs. Thank you for dropping in on the home of free financial content on YouTube. While you are here, please like and subscribe as you don't want to miss a single moment, and a huge thank you for that click. We will get to the individual funds, but before we do, I want to break down a few positives about these funds before, of course, we address the whole return of capital fear that some of you may be bringing into this video. Obviously, the higher yields, which range from 6% all the way up to 18.40%, are a huge plus. People do not come to a high-yield ETF without that expectation. Another big plus is that these ETFs are hedged to the Canadian dollar. This removes the whole currency conversion factor from the equation, which does make investing much simpler. The third bonus is that the underlying stock in these ETFs will bring some growth once we move into a bull market, and this has the potential of turning these ETFs into some solid growth as well as high dividends at the same time. Total growth stocks, perhaps. One final advantage is that these ETFs are all, well, monthly payers. A lot of the underlying securities are quarterly, so it's kind of nice to get a piece of the pie on a more regular basis. When it comes to the cons, the return of capital fear may rear its ugly little head. I want to reassure you that I do not believe they are using this strategy to meet their dividends. Some split core do use the strategy, whereas they return some of your capital to top up their dividends when their earnings fall short. Effectively, this strategy ends up lowering your average cost base, which means if you are in a non-registered account and then you decide to sell, well, you're going to have some larger capital gains or smaller capital losses to work with, and that of course can have tax implications. In the past, with the high-yield crypto ETFs, instead of keeping the dividend payout per share constant, they do adjust it down when they fall short instead of a return of capital. In most cases, the yield is still better than a lot of other options. Of course, if you really do fear return of capital, just place these ETFs in a registered account like your TFSA or your RRSP, and you're good. Okay, let's look at these ETFs and see what Purpose has in store for us. Up first, we have the Berkshire Hathaway Yield Shares Purpose ETF. They have a ticker of BRKY. This is a great way to become a part of Warren Buffett's big company at a reasonably affordable price. This is the low end of the spectrum because this fund has a dividend yield of 6%, which is paid out monthly in the amount of 10 cents per share. Their NAV comes in at $20.48, and they have a management fee of 0.40%. Next, we have the Apple Yield Shares Purpose ETF with a ticker of APLY. This is a great way to gain exposure to one of America's big tech companies. Apple is just a company that innovates and dominates a good part of the market. This fund has a dividend yield of 10%, which is paid out monthly in the amount of 16.67 cents per share. Their NAV comes in at $19.96, and they also have a management fee of 0.40%. Next, as we continue the who's who in tech, we have the Alphabet Yield Shares Purpose ETF, and they have a ticker of YGOG. Google is pure magic when it comes to how they have dominated search, with both their search engine and also with YouTube. This ETF has a dividend yield of 11%, which is paid out monthly in the amount of 18.33 cents per share. Their NAV comes in at $20.22, and they also, like the other two, have a management fee of 0.40%. Our next ETF is the Amazon Yield Shares Purpose ETF with a ticker of YAMZ. This e-commerce juggernaut may be struggling lately, but they are ripe for a comeback in the bull market. This ETF has a dividend yield of 12%, which which is paid out monthly in the amount of 20 cents per share. Their NAV comes in at $20.07, and, well, they as well have a management fee of 0.40%. Finally, we have the Tesla Yield Shares Purpose ETF with a ticker of YTSL. Love or hate Elon, this is a company that every time we have thought them down for the count, they found a way to come back. So you never know. The Tesla ETF has a dividend yield of 18.40%, which is paid out monthly in the amount of $30.67 per share. Their NAV comes in at $15.76, and they have a management fee of 0.40%. These are some very good tech companies that really should have no problems returning to former glory. But yes, times are tough for tech, and that is interesting with a strategy such as the one Purpose is employing. In a nutshell, these ETFs have a covered call strategy that will only use up to 50% of their underlying shares. In addition to that, they also use moderate leverage on 25% of the fund. This balance of covered calls and leverage seems to be the sweet spot when it comes to risk and reward. These funds will do absolutely amazing in a sideways market, and that of course is due to the fact that they can get a much higher premium on their covered calls. In a bear market like we are in now, they will perform or even overperform provided there is a lot of volatility in the market. If you get the other end and you get a bunch of low volatility in a bear market, they're going to struggle a bit. Likewise, in a bull market, they will do better in low volatility, and they can actually struggle in a bear market if you get way too much volatility. Here's the thing. These are new ETFs, and as such, there is not a lot of past performance we can use to actually judge how it might go. The closest we have is their other high yield products, well, like BTCY. If we look at BTCY, their first dividend on December 29th, 2021 was 10 cents per share with a share price of $8.28. That is a yield of 14.49%. Bitcoin was basically destroyed since then, and that share has fallen all the way down to $2.82 on November 28th, 2022, the date of their last dividend, well, at the time of recording. Their dividend payment on that date was 2.3 cents. That is a yield of 9.79%. Unfortunately, we have only got to witness Bitcoin moving down over the life of that ETF, but we suspect that dividend will rise again as Bitcoin sees better days. The plus to starting these new tech high yields now is, well, hopefully the majority of tech's crash is behind us. Some believe the bottom is coming in early 2023, but we will of course have to see. I do not believe we will see as drastic a drop as we have already seen with these stocks, but nobody really truly knows the future, and maybe the doomsayers when it comes to the market are right. I certainly hope not. With any high yield, the rule of thumb is to pay attention to them and to remember the due diligence never really ends. These may turn out to be fantastic, and I sure hope so, but I plan to keep my expectations, well, much more realistic. The fun does not have to end here. Check out my video on Algonquin Power that I have linked over there on the left. Otherwise, check out the video on the right that YouTube thinks you will like. Your click will decide who is right. And I'll see you in the next video.